but they're not going to go after the continued corruption because those are their sources. They depend on them for their daily and weekly articles. Some of them, and we know this from some cases that were brought in overstock, some of them are bought off. Some of them are paid. People have testified that they give money to certain journalists. They're paid. Some of them are just lazy or stupid.
Hi everyone. Before we get started, I have to plug a few quick things. First of all, my book, Brexit, The Establishment Civil War, is now available to order. You can read some chapter previews by following the link in the description below. Our sponsors, Expressvpn, get 35% off 12 months of Expressvpn and get 25% off podcast hosting with Podium. Finally, if you're watching this on YouTube, please go check out odyssey.com instead. We are hosting all our videos there. If you're a creator, you can move your videos across with one simple click, and you can earn cryptocurrency simply by watching videos and use it to tip your favorite creators like myself. So please check that all out if you want to support the show. Anyway, here's the podcast. Hello and welcome to another episode of Chatter. Today I have the absolute pleasure of being able to interview Lucy Komisar, investigative journalist. Lucy, welcome to the show.
Thank you. Thank you.
No problem. So we are here to talk all about GameStop and naked short selling and the entire saga that surrounded that. So I wanted to start out and ask you about something that has been brought up a few times in some of the Ask Me Anythings about GameStop, and that is the death spiral deals and death spiral financing. Could you give me like a better understanding of what that is and what it entails?
Mm-hmm. The name used by investment firms that offer this is convertible debentures, or PIPE, which means private investment in public equity. The targets are, they would say clients, I would say targets, are generally small companies who need capital, but aren't at the stage where they can get cash from stock sales or bank loans or bonds. In one case, the investment firm says, "We will lend you $2.5 million. That's the sum that was promised the company that was caught in this trap. It would be paid back in stock equivalent from $2.5 million. The loan was $2.5 million. They would pay back stock equivalent to $3 million. But at various dates, the investors would request conversions of the debentures until the $3 million was paid back. The company hopes this money will help them grow and the stock price will go up. And this makes this a very good deal. They don't know that some of the investment company people and the people they're working with are corrupt. Now you have to know about naked short selling. Naked short selling is where an investor sells a share he doesn't own. Yes, this is allowed by the SEC and other countries, and must borrow or locate it in the stock of some other company that has that stock. Borrow means his broker borrows it from another broker who takes it from a margin account of a client who permits the stock to be loaned because they're not paying for the whole amount of stock in cash. And the broker gets interest on the loan and sends the borrowed shares to the buyer, to the seller who sends them to the buyer. In 2 days, the short seller must pay back the loan. A locate means the broker knows where the stock can be obtained. This is usually fake, doesn't really know anything. And the seller must send the shares to the buyer in 2 days. But the naked short sellers never cover. They never send the shares to the buyers to begin with or after the 2 days. And they increase the number of shares in the marketplace because the buyer who never got delivery in the DTCC, which is the clearinghouse for shares, that person has gotten a digital entitlement. Well, the real owner of the shares still has a digital entitlement. So you increase the number of shares in the market, and that drives down the price. And when they are involved in death spiral financing, that's what happened. So, but it's deliberate to the point of real conspiracy. The naked short sellers knock down the share price. So by the time the conversions are required, each tranche will be paid back in many times more stock. So that if 3 million would have given, just take a number, the lenders a tenth of the company, by the time they're through, they'll own most of the company, or maybe even push it to bankruptcy, which means they never have to cover the shorts, the naked shorts, because there are no more shares. So let me tell you about a particular case. Eagle Tech, based in Fort Lauderdale, Florida, was started by Rod Young, who had developed the use of a single telephone line for one number, follow me telephone service. Now, it's not so surprising. At that time, 20 years ago, it didn't exist. He needed money to develop the invention, and he fell into a death spiral trap. He thought the deal was honest because it was sponsored by Salomon Smith Barney, then owned by Citigroup. Meetings were held at their offices. Notices were sent out on Salomon Smith Barney letterhead and in Salomon Smith Barney envelopes. The Salomon leader of the deal, John Dorosky, worked with a bunch of mafiosi, literally mobsters, who fronted for investors that were really offshore shells. The agreement that Eagle Tech signed with Salomon banned naked short selling. But the chief mobster involved in the deal, John Cerubo, paid illegal commissions to some cooperating brokers to do just that, naked short sell, not cover. So, and then the investments didn't materialize, or they were canceled out by the massive naked short selling. But other so-called proper companies were involved. Knight Securities, a broker-dealer, facilitated a series of coordinated, synchronized short sales to drive down the price. In one case, a high of $13.25 to $7.75, and giving the shorts a profit of $5.50. So at a certain point, this kept happening. Eagle Tech finally smelled a rat and refused any more conversions that would transfer the company to the Salomon Smith Barney co-conspirators. Now, the FBI was investigating some organized crime stock fraud. It busted 17 mob members in New Jersey, led by the crooks that ran the scheme against Eagle Tech in cooperation with Salomon Smith Barney. It never got near Salomon Smith Barney. In February 2005, the SEC brought a securities fraud case against Cerubo, a leader of the mob, and more than a dozen others. It said they generated over $12.7 million from the sale of stock. And Cerubo and the other mobsters would be banned from penny stock trading in order to pay back the ill-gotten gains. Now, Salomon Smith Barney was a member of the New York Stock Exchange, which is subject to oversight by the SEC. And the SEC and the Justice Department never got involved in looking into the role of Salomon. Eagle Tech's lawyers, and Wes Christian, the main lawyer, told me, we contacted the SEC on that and got no response at all. He said it was gross negligence. I think it's more than negligence. I think it's corruption. So the court dismissed the Eagle Tech suit because it said it lumped 29 defendants together and failed to identify which defendant made which statement, which I think on the face of it, when there's a conspiracy, it's pretty outrageous. Then the SEC, this is the final, the coup de grace. The SEC filed suit against the victim, Eagle Tech, to deregister its shares because it couldn't afford several $100,000 to file audited financial reports. So delisting is like a bankruptcy. All the investors are wiped out. The naked shorters never have to cover. So the SEC figured what the mob started. It killed the company. There's a very similar story happened about the same time. Sedona was a software firm based in King of Prussia, Pennsylvania. It was making relationship management software for companies. Again, this was 2 decades ago. There wasn't a lot of it around. It had some deals working with IBM and other top-line financial companies. it wanted to hire more staff for sales and marketing. So in this case, the investment banker was Ladenburg Thalmann, which was considered a very high-level investment company. It was prominent. It was a member of the New York Stock Exchange since 1879. Its major investor was Carl Icahn. From this company was a man named Michael Vasinkovich. He was soliciting Sedona's business, promising he could help finance the company growth. He could get Sedona, that's the $2.5 million, in a pipe deal, private investment in public equity. He was working with two Austrian brothers, the Badians, and they were introduced as investment advisors. They work through a network of offshore funds, advisors, directors who seek out target companies. The investors, the shell companies in this case, were controlled by Herbert Batliner, who, according to a 1999 German intelligence document, which I obtained, was in the business of laundering illicit funds. And the U.S. prosecutors told a Colorado federal court in 1999, and this is public, Batliner had handled money for drug dealer Jorge Hugo Reyes Torres, then was serving a prison sentence in Ecuador. So this fine group, the Badians, through their Rhino investors, their shell company, pumped $2.5 million into Sedona in 2000. And they made a convertible debt offering, which would be converted at various points. And the deal was written. The investors would not short sell the stock. But of course, that would be a lie because short selling would push down the share price and they would get more shares for the $3 million. So it came time to convert the shares. When the deal was signed in 2000, the stock was trading at $6 a share. They in a month they pumped it up to $10.25 from $6. Then a long slide. Every time the company put out good news, such as a relationship with IBM, should have made the stock go up a lot. There was a heavy sell through electronic communications networks that allow the seller to hide behind the ECN. And in a month, the Confederates pushed down the stock to $1.01. Now, when Andreas Badian learned the price of the stock had fallen below $1, he told the brokers at Westminster, fine New York brokerage, according to tapes, which now became part of one of the legal cases, to, quote, keep selling and use unbridled levels of aggression because every dollar that you sell is a dollar in my pocket. And meanwhile, the phony clients were converting the shares to cash. And so they ended up, Sedona still owed $1.9 million after all the conversions. And they were deposited, the shares were deposited into another fine firm, Westminster Securities in New York. And Pershing, a clearing firm for Westminster, shared office space with some of the Badian funds. I'm trying to point out that, like in the Eagletech case, you have some very grungy crooks and you have some very fine Wall Street firms. Badian directed Westminster to engage in manipulative short selling, and Pershing brokered the transaction. Another company, a market maker named Frankel, made fake book entries that said it had bought the shares through a broker in Canada. And so Sedona one day received an investigator's 330-page ring binder. There's an investigator, I think I know who it was, had been looking into this whole special part of the naked short selling scams, the death spiral financing. He had analyzed 60 companies destroyed by the Badians and similar operators. And then in 2001, Badian demanded another conversion. Sedona decided it was dealing with crooks, and it refused. It got an appointment with the SEC and the Justice Department, had meetings. The SEC found out that 82 companies reporting investments by the same scammers, of them, 81 lost almost 40% of market value in the first year. And Sedona lost a lot of business because if your stock is tanking, companies don't want to buy software that you are not going to be around to service. So Sedona had to fire employees in sales and marketing. So following meetings between Sedona and the Justice Department and the SEC in 2003 filed a complaint against Badian and his company for fraud and market manipulation. You know what the settlement was? It was $1 million. That was chump change. That was the cost of doing business. And they did not have to admit or deny guilt. They were big-time crooks. They got off. The Justice Department charged Badian in a criminal case. He jumped bail and is a fugitive in Vienna. And then finally, the Justice Department just dropped its criminal case against Andreas, and it would not say why. So in May of 2003, that's when Wes Christian got involved. He filed a civil suit for Sedona against Laudenberg, which was the big guy, and Vasinkovich, Badian, and some others. Finally, the SEC filed a suit against Badian, but not against Laudenberg, and or against Westminster or any of the other major brokers involved. And Wes Christian told me the U.S. government chose to go after the low-hanging fruit, the Badians. They had the clearing firm, the broker-dealers, they had it all, but they dropped it. The judge in New York sat on the cases for nearly a decade. She dismissed most of the Sedona defendants, including Badian and Vasinkovich, and the alleged co-conspirators, Pershing, Westminster, Frankel, got a pass from the SEC and the Justice Department. Finally, Wes Christian settled with Laudenberg, Thalman. He can't indicate the money of the settlement, but obviously Laudenberg at a certain point decided it might not be good publicity for them. So Sedona is still in business. It now has a market cap of 1.9 million. The stock is trading at 2 cents. This is what death spiral financing does.
Yeah, I mean, it sounds like such a predatory practice. It's really difficult for me to try and get my head around just how this is allowed. This is one of the things that I'm having the most trouble with at the minute with trying to write this story. Is that, and I mentioned this to Carl Hagberg, is that when I try to say okay, and I explain this story to someone, they just go, that sounds like you're wrong. That can't be how it works. It can't be this corrupt, or it can't be this openly. No, Carl was unhappy with my use of the word fraudulent, but that's what it looks like just to someone who's only come into this now. And I know I'd planned to ask this later, but it just seems like the best time to do it is how is this level of corruption and conflict of interest possible? I don't understand how how a country set up on checks and balances and attempting to make sure no one group had too much power, and obviously it's become corrupted, but how did we get to the point where this level of just really dangerous and yeah, in my mind, fraudulent practice is accepted?
I think the problem is that the big financial firms, Wall Street, has a lot of control over the government. We have a system where there's a revolving door between Wall Street and the SEC, where people from Justice Department also then go to the big law firms who have these financial companies as their clients. So it's what you're suggesting. It's very corrupt. The system is corrupt. You just have to know the details of the cases to know the system is corrupt. That there isn't a system of checks and balances. There's a system of control by corrupt entities who pay off members of Congress. Look at campaign contributions. When I saw the House hearing into GameStop issues, it was led by Maxine Waters, who's head of the House Financial Services Committee. I looked up who her donors were. Her big top donors were private equity funds, financial companies. That's who pays her. That's how she can stay in her seat. So of course she wasn't going to talk about naked short selling. That was the furthest thing from her mind. So that's the answer to your question.
Yeah. Now, you mentioned in one of your Ask Me Anythings, forgive me, I don't remember which one, but you mentioned that the removal of Glass-Steagall was a big moment in the sort of history of this sort of financial corruption. Why was that such a big moment? Like, do you want to like explain why that was the crucial moment that you've laid it out to be?
Well, after the 1929 stock market crash, Glass-Steagall was part of legislation passed in 1933. In the crash, people lost their savings when banks failed because the banks had used their money for the bank's own investments. So the Banking Act of 1933 separated commercial and investment banking. You couldn't take depositors' money for your own investments. But U.S. President Bill Clinton and his Treasury Secretary Robert Rubin took their orders from Wall Street. Rubin, in fact, had worked for nearly 3 decades for Goldman Sachs, and they got a compliant Congress. Many depended on Wall Street campaign contributions. So in 1999, they repealed Glass-Steagall, opening the way for the crooks to have their way. So bank holding companies previously could not engage in activities such as insurance and investment banking. Now they could. Well, this helped them a lot. And the 6 biggest banks went from controlling 15% of the GDP in the U.S. to 65%, because now they were not just banks, they were investment companies. There were giant mergers, such as a $33 billion deal between J.P. Morgan and Chase Manhattan. The next year, the Bank of America took over 2 financial companies, Countrywide Financial Services and Merrill Lynch. Both were in difficulty. It couldn't have done that before. So we got a massive agglomeration in the financial system to make these institutions much more powerful. Joseph Stiglitz, the economist Joseph Stiglitz, said, bringing investment and commercial banks together, the investment bank culture came out on top. And we know what the culture is. There was a demand for the kind of high returns that could be obtained only through high leverage and big risk taking. And that led to the 2008 crash. And that's why there's still a danger, because the banks where people put their money are still doing risky investments.
Yeah, it's sometimes when I hear that specific regulations were removed, not even specifically Glass-Steagall, but I get this feeling. It's like, who voted this through and thought this was just a good idea? But dark pool trading has been discussed a lot on Reddit, on Superstonk, and quite widely. And it's been a difficult concept for me to get my head around. But essentially, now you can correct me if this is a wrong understanding of it, is just another exchange that is less visible and a way for hedge funds to make their activity maybe not unknown, but just not as obvious to the market as a whole. And I think you mentioned in your AMA that it's got to something like 40% of all trades made in the market today are done through dark pools, and now that seems like a lot. How have we got to that point where almost half of the trades are taking place off market?
Thanks so much for listening. If you enjoyed the show, please subscribe, follow me on Twitter, or sign up to our mailing list. Thanks a lot to our sponsor, Expressvpn, the #1 most trusted VPN. Get lightning fast connectivity with servers in 160 locations across 94 countries. Keep your browsing privacy safe with Expressvpn and get a 35% discount on 12 months of Expressvpn when you follow the link in the description below. Don't forget, my book is now out and available to order on Amazon and on bookshop.org. That's Brexit, the Establishment Civil War. And most importantly, thanks for listening. We'll see you next time.
the NSCC, which is the National Securities Clearing Corporation, is supposed to settle the trades, which means moving the digital entitlements between the buyers and sellers brokers. However, since the 1990s, dark pools have enhanced the system of X-clearing. X-clearing is avoiding going through the DTCC. It could be done easily with a very big brokers such as Goldman or Morgan Stanley, because they have so many clients that they may have one client buying something and the other client wanting to sell something, and they can just do the settlement just inside. They never have to go to the DTCC. X-clearing means clearing outside the normal clearing process. Now, dark pools was an enhancement of that. They are markets run by private firms or banks, prime brokers. They trade outside the stock exchanges, and they're hidden from most investors. They're not exchanges, but they are exchanges. They're internal crossing, X-clearing, moving the stocks away from going through the exchanges, which are public. And they're used by clients such as hedge funds to buy and sell large blocks of shares in anonymity. The idea was, we don't want to move the public price of a stock on an exchange because there'll be copycatting, because maybe they need to buy, a buyer needs to buy a huge amount and can't get it all from one source. So the broker will buy part of it. And if it's on the exchange that's open, everybody will see this huge amount has just been bought. Therefore, other people are going to buy it. Therefore, the stock price will go up. And so the big guy who wants to buy the rest of the shares is going to pay more. So that was the reason for the dark pools. The large traders could act secretly. They wouldn't inform the trading public that they're looking to buy or sell some shares. And the trades were confidential. In theory, neither side knew the party on the other side. Now, the dark pool operators knew both sides. And if they were trading on their own account, they could use that information. And so that's what officially dark pools were about. Now, 40% of shares go X-clearing. Most of them, it's hard really to tell, because everything is so secret, but most of them seems to be through the dark pools, and they don't go through the DTCC. So the prime brokers move them between their own clients or through companies they own, because the big prime brokers, they own the dark pools. And so it's not some unlit building where people exchange shares. I'll give you this, you give me that, and they wear they have secret handshakes. It's all done by computer, but it evades the DTCC. So
well, that's the point.
They evade the more stringent post-trade reporting. It's hard for regulators to look at specific trades. So a lot of the trades go below the radar. They may be netting a lot, never reporting at all. That means I sold this much and I bought this much, therefore there's zeros. They don't report anything. Zero is net. It's netted to zero. So if you put the dark pools with the financial company broker-dealers X-clearing, it really increases the possibility for concealing illegal trading activities and market manipulation. Why are they secret? The prime brokers want it that way. It's a way to do scam trading without being called to account. Except now, how did this get out of jail card free get written into the SEC rules? And the key scam trading they do is through naked shorting, because the SEC Reg Show for short, the regulation on naked short selling, went into effect in 2005. It applies only to shares that settle through the DTCC. The Reg Show kept saying, the SEC kept saying, because X-clearing is so rare. So if a company's trades fail because the shorts were never covered, they don't fail if they weren't sent to the DTCC. So the dark pools that bypass the DTCC means there's no way for the DTCC to know if trades were really completed, if shares were delivered, if shares are processed X-clearing. They would only be known to the trading parties. It's an extra layer of secrecy because this is very helpful. I said before that the vault, the DTC, has in its records the entitlements, the shares of each prime broker that the prime broker is keeping for its clients. Well, we have found out in comparing claimed shares to shares in the DTC, there's a huge amount of shares that really don't exist. That's why they can't be in the DTC, because you can only have real shares where you got a real entitlement, and the dark pools will cover up the fact that a lot of the shares being moved around are counterfeit. That's why there's overvoting. That's why companies like Taser, the stun gun company, found they had a vote where they had 60,000 shares. They were 60 million shares. There were 80 million votes. Those 80 million shares cannot be in the DTC because they're not real shares. So they stay in the dark pools. They're a license to naked short, which means a license to steal. And the buyers don't know about this. The other thing they lose is they have digital entitlements from their broker. But if you don't have real shares, you can't get the cheaper capital gains tax rates, and you cannot vote. But the brokers don't tell their clients that. Very often they even send them proxies, but then they don't file them with the company or with the proxy handler because they won't be accepted, but they don't want their clients to know. And what they do is they send the clients payments, which are called in lieu of dividends. Probably if you got a check or you got an announcement, you got this money, you don't think about it. It's because in lieu of dividends, they're not entitled to real dividends because they don't have real shares. Now, to get back to GameStop, the dark pools played a role in the GameStop manipulation. 25% of the GME float is traded over the counter compared to less than 1% for major stocks. Compare that. 25% compared to 1%. Why would they do that? The total GME volume traded off exchange skyrocketed in January. There was a spike in dark pool trades, especially the last week when the short squeeze was on, and then it was shut down. The big investors who trade in dark pools increased their volume till that week when the price dropped. And in February, over 500% of the float, and this is amazing, it could be like that, was traded off exchange in dark pools. Massive repeat high frequency trades is one of the ways that happens. You know, if you're doing a high frequency trade, you are not borrowing or locating a share. It happens in nanoseconds. Then the GameStop over the counter, OTC over the counter, which means all of the things that don't go through the DTCC. The volume as a percentage of the float was over 200 times higher than the average volume as a percentage of the float for Dow stocks. And each time they took another measure. For instance, the average over-the-counter trading for Dow 30 in February was 2.8% as a percentage of float, and it was 234% for GameStop. So you know something very crooked is happening there. The other thing that happened that was really interesting with GameStop is the average trade size was always very large. That was the purpose of the dark pools. Well, when they got into the manipulation, the average size decreased to less than 50 shares per trade. What major hedge fund is buying shares at 50 shares per trade? And it went down as far as 1 share per trade. So this was meant to, through high frequency trading, to manipulate the market. And that is what has happened with dark pools. They're another mechanism to manipulate and cheat.
Now, Lucy, one of the things I absolutely love about you and about watching your interviews and your AMAs is your fearlessness to just say what you believe and what you see. There's not many journalists would go as far as to call a lot of what you've said there a license to steal.
But, it is.
Yeah, it is. I'm not saying you're wrong. I'm truly admiring your willingness to come out and say it, because the veiled language that
the reason mainstream journalists don't say these things for a number of reasons. One is their sources are the people that I'm talking about, and so they can't call somebody a crook. They can write, if there has been an SEC or Justice Department enforcement, they can do a story about that. They won't follow it up much, but they'll say this happened. This company was fined and full stop. But they're not going to go after the continued corruption, because those are their sources. They depend on them for their daily and weekly articles. Some of them, and we know this from some cases that were brought in overstock, some of them are bought off. Some of them are paid. People have testified that they give money to certain journalists. They're paid. Some of them are just lazy or stupid. Sorry. It takes a lot of work to do this. It's so much easier to rewrite a press release, which I think is what most of them do. So if you're lazy or stupid and you don't want to make waves, you don't talk about these things. It's only because of the massive spike in the market with GameStop that anybody is even talking about this, even though some of the tactics have been used for years.
Yeah, I mean, I guess that's one of the things that's really stunning about trying to learn about what's happening here, is that at the beginning, I didn't believe that this has happened in any other place, really. I didn't think that this had gone on in any other situation. I was like, well, something like this couldn't have happened before because something would have been done about it. Perhaps that was the naive January version of myself. But there's one thing I wanted to get into there, actually, that you mentioned early on in that answer, is that because when shares are settled or traded off of the DTCC, that means that they're not counted towards failure to delivers. Does that mean that the failure to deliver rate could actually theoretically be much higher than what we are seeing officially?
Yeah.
Yeah? Okay.
They keep all the numbers in their books. And, they have the customers on both sides. They have the short sellers and they have the buyers who don't realize they didn't get anything. And that's why they're sending them dividends in lieu of dividends. So they know that. You wouldn't be sending your clients money in lieu of dividends if they had the real stock.
Do you think there is a way to find out how many synthetic shares actually exist?
There are the agencies, the SEC, the DTCC. They could find out if they wanted to. There's various avenues of reporting that the companies have to do. But for example, when they come out with their numbers about shorts, they don't say what broker is responsible for those shorts. They just say there were these many shorts in this stock. So they'll mention GameStop, but they won't mention who shorted and who failed. And they will know who failed because they will know what is claimed and what is real. They don't want to do that. You see, the DTCC, this is a key point, which I didn't mention, is owned by the broker-dealers. They are on the board. They literally own the DTCC. And they not so literally, but actually own the SEC because of the revolving door. But they literally own the DTCC. So why would the DTCC tell the names of their owners who are involved in naked short selling, who are putting out sending shares to clients when they know they don't exist? Because they know what they have in their vault. They know what they got if they did trades with other prime dealers, each for their own clients. They have all those numbers. They have to have all those numbers. But we are run by systems that don't want the truth to get out because they're owned by the miscreants.
Yeah, I mean, it's kind of concerning. I mean, I'm not particularly expecting them to come forward with the numbers, but I was just curious as if there would be a mechanism if, we just decided to storm in and go,
well,
right, give us the numbers.
There are various ways that, for example, one way that is part of this is, and this was attempted in about 2009 by Senator Kaufman, who replaced Biden when Biden went to be vice president with Obama. His Delaware seat was open. So Ted Kaufman, who had been his chief of staff, was named to the seat, and he said he was not going to run the next year for re-election. He was just going to do it for 1 year. So instead of spending all his time raising money, he went to work in this area. And what he wanted to do, and proposed it, there be a hard locate. What that means is if you're doing naked short selling, you must locate the stock, the share that you're borrowing, and each share will have an identifying number so that nobody can borrow the same share twice or say they have located that share twice, 3 times, 10 times. And the SEC knocked it down. They did not want that. Obviously, if Gary Gensler, the new SEC chair, is serious, that's the first thing he has to do. Also interesting is that Ted Kaufman was the leader of the Biden transition team, and he's still very close to Biden. I wonder if he is talking to him about this, if Biden is interested in boosting the economy. One way to do it is to stop this cheating. So there are mechanisms out there that could be used, and really with a system of everything being computerized, it's not so hard. But it's a question of the will, and the will is not there. Look, this is like asking Al Capone to set up an agency to deal with tax cheating. And he's in charge of the agency. He's going to do a wonderful bang-up job. Isn't Al Capone going to do that? Well, that's what we have now.
Yeah. Pablo Escobar in charge of the drug smuggling laws. Yeah, I loved your analogy when you used that before. So one of the things that seems to be very prevalent to me is that it's not just in America, it's across much of the developed world. The financial sector over the past 30 to 40 years has grown increasingly powerful and has captured essentially a lot of the regulators and quite a lot of the major parties, especially in the US and Britain, where I'm like most familiar with the situations. Now, how concerned are you with this capture? Because for me, this seems to be like a really crucial issue that no one really addresses what the consequences of it are. Because if our regulators are completely bought by the people they're meant to be regulating, we don't, like, the system doesn't work then. And no one seems to say that. Like, is that a bit too much like the end is near, doomsday sort of person? Or like, how concerned are you about
crashes.
This?
There were crashes. There was the 29 crash and the 08 crash, and there was the flash crash. Plenty of crashes. It's built into this system. I don't know what happens in every other country. I know that in South Korea, there's a big regulatory push against naked short selling, and they are probably doing more than the Americans, but I see all the time that they are going after anybody who might be suspected of naked short selling, and they're really very tough on it. Take the UK, on the other hand. The UK is very open to all kinds of financial shenanigans. One interesting story is, and I hope some UK reporters will take this up, at the time of the collapse of Lehman Brothers, Lehman was doing something called rehypothecation. That means you can lend out shares in margin accounts. But it means also what happened is other people who got the loan would then lend them out and would then lend them out again. So you had a daisy chain, but there were still digital entitlements for each of them. In the U.S., there's a rule you could lend out only 140% of the real shares that you have, which I think on the face of it is absurd. In the UK, there is no limit at all. And these were being used to cover shorts. That's why it's relevant here. They would lend out a share to some prime broker, who would use it to cover shorts. But maybe those shares had also been rehypothecated to another prime broker who would use it to cover shorts. Well, when Lehman collapsed in 2008, there were some clients, American clients, who wanted their shares back. They didn't know where they couldn't get them. I spoke to a lawyer for a client who said, my client wanted the shares back and was told they had been rehypothecated to the UK. And I don't know if they ever got them back, but when you lend and lend and lend, and at a certain point, who is the real owner of these shares that have been lent out to cover shorts? She told me that she went to a meeting in London of big brokers and officials, other people that would have been concerned with this issue. And she said, well, maybe we should do what the Americans do and have a 140% limit on what you can rehypothecate if you have these shares in your accounts. And they said, oh, no. We are making too much money lending these shares out multiple times. And so the UK still has this smoke and mirrors system of rehypothecation. Now, this is the kind of thing where when the music stops and everybody tries to sit down, somebody doesn't have a chair. And that's the problem. These things go on and on and on until there's some crisis, and then the music stops. And that could happen in some of these other countries. And of course, these big brokers and hedge funds all have subsidiaries in many, many countries. Especially the banks have subsidiaries in and a lot of offshore subsidiaries. So you don't really know what's going on there, where they are moving shares, how they're dealing with the loans. You know, the loans, the stock loans, it's the major part. People don't know this. It's the major part of the profits of the big the prime brokers. I've seen the number 75%. It's massive. Massive.
Yeah, hang on. Let me just correct, make sure I've got this right. You're saying that 75% of the profits of big institutions in some cases come simply from loaning shares out that are on their books.
This was from investigation, the discovery in Goldman Sachs, the overstock case against Goldman and Merrill. And I talked to one of the investigators who had worked with Patrick Byrne on this case. And he said they were astonished. He said, I thought, must be a big number. This may be 20%. But in discovery, he said, we were astonished to find that they were getting 75% of their profits from stock loans. Now, two things about that. One is, and there have been cases on this. In some cases, they have made loans to brokers or to clients, to brokers on behalf of clients who were shorting and needed shares to cover the short, and they never sent any share. They charged them, and sometimes for hard to borrow, like Overstock, it could go to 50% of the cost of the share. It was very, very high. And there was a suit by a company called ETG, the Electronic Trading Group, and they sued all the prime brokers, and they said, we have been paying you to get shares to cover shorts, and we believe you are not providing real shares. And the problem at that time, and probably still the case, they lost in the lower court because the court said, well, the federal court, we don't have jurisdiction. The SEC has jurisdiction over this. You have to go to the SEC with your complaint. Went to the next court, the appeals court, and they said the same thing. And it went to the Supreme Court, and the Supreme Court declined to take the case. So here we got the fox guarding the hen house, and one of the hens is complaining, the fox is out to kill us. And the farmer says, I'm sorry, the fox is in charge of the hen house, and nothing I can do about it. That's what happened there. So in many cases, if you look at the numbers at the short interest, those are shares not yet covered. And that was true for GameStop. A huge number of shares, the short interest, meaning shares not yet covered. They couldn't cover them because they said they were lending out shares to the short sellers, but they didn't have real shares. They didn't have anything. It was fake. Either the real shares to send them that they were borrowing or the locates. It was all fake. And the reason is they get a lot of money for these non-existent shares that they are supposedly lending out. That's the dirty little secret of why the naked short selling is so central to what the prime brokers and big banks, because they're now connected, what they are doing.
You're kind of blowing my mind a little bit here. I mean, I think you've understated it there. It's not a little secret. This is a huge fucking secret. Like, this is insane. I mean, I knew it was corrupt, but wow. It blows my mind when you think, because they're just like what you're describing there. Like, and again, correct me if I've misconstrued this, is that a vast portion of the profits of this, of the apparently very lucrative financial industry in some parts, is just coming from selling things that don't exist.
Yes.
Yeah.
It's called fraud.
Okay. Yeah. Like, that's, if you did this in any other world, you would be in jail like that. Like, by the end of the week, if I sold a car that didn't exist, I would be in a police station by the end of the week. It's so crazy. I'm aware we're coming to the end of our time here, so I'll kind of wrap these last two questions into one. So what do you think is going to be the result of this? Is this going to be like a watershed moment, and we're going to get a lot of regulations put in place? There's going to be some sort of movement from Congress, or do you think that's even possible whilst Wall Street has the connections and the financial clout to continue to get politicians reelected? While they still have that influence, is it possible to regulate them?
Well, right now we have a consciousness raising moment pulled together by investors acting through Wall Street bets and super stonk. But the corporate interests control the system, and they have ignored these kinds of public movements before. People can see this video and they can see the super stonk videos, but the masses of the public read the corporate media, and they don't write these things. Now, the House and Senate Finance Committees held special hearings, allegedly as the result of the GameStop events. They utterly ignored the role of naked short selling. The regulators were called to testify. The heads of the SEC, the DTCC, FINRA, that's the Financial Industry Regulatory Authority, which is the broker's self-regulator, except they're all the broker's self-regulators. They did not mention the words naked short selling at all. So until there is a much more of a raised consciousness, until now they're moving into AMC and another stock, an entertainment movie theater stock. Maybe this will happen on others. Maybe it has to reach some critical mass for people to be aware, for members of Congress to be aware, because I haven't seen anybody in Congress, including the so-called good guys, talking about this. I'm waiting for Elizabeth Warren to talk about this. She has talked a lot about problems of the financial system and financial organizations such as the prime brokers. I haven't heard her speak about naked short selling. Haven't heard Bernie Sanders speak about it. So we have to wait for that. And I don't know what it's going to take to push that. Another crash, like the 2008 crash. I don't know about that. But we just have to wait. It's very hard to predict. So many things have happened, such as the 2008 crash. You would have thought that would have brought about some changes. We had the Dodd-Frank law, which supposedly had rules for example, for more transparency. That was in 2010. The Dodd-Frank law ordered the SEC to come up with a system for more transparency. It's 11 years later. They have done nothing Nothing. And nobody in Congress, including all the people that voted for this legislation, have brought them to account. So that's the problem is, when does it hurt enough, and when does it even hurt some of the more important people? Because remember, a lot of the stocks are owned by the very wealthy. They're also owned by pension funds, waiting for the people who were hurt. But right now, I don't see it happening. There's no transparency in short selling and no transparency in stock lending. That's the SEC was ordered to do that, and it has not done that. And those are the key issues.
Well, I mean, all of us can hope is that this is the start of some sort of moment or watershed or catalyst for trying to clean up the system. So, Lucy, I want to thank you so much for your time. It's been a pleasure. I want to leave everyone with a quote that you read, I think in the AMA you did about the SEC. I think it went, he who sells what isn't his'n must buy it back or go to prison, which keeps running around my head. I love it so much. And I wish all SEC regulations rhymed.
Mm-hmm. Well, that wasn't, that's from the stock market crash of 29. And it supposedly was said by somebody, but it may be apocryphal. But it goes back to that, because the stock market crash was caused in large part by naked short selling. We go full circle. Watering the stock meant that you printed up, because then it was printing. There were no computers. The crooks printed up shares of stock, forged shares of stock, and sold them, because when you got stock, what you really got was a piece of paper. That was your share of the stock. That was legal tender. And they printed them up. And they printed up more than really existed, and that was called watering the stock. And some people went to jail for that, and that's why this meme came out. But watering the stock is naked short selling. And if that happened in 1929, and now it's how many years later? It's 90, 100? Well, 90 years 92. Later, I guess. It's a long time, and the problem still hasn't been solved. What happened at that time when Roosevelt established the SEC, it was through the legislation of 1933-34, he put in charge Joseph Kennedy. That was the father of John and Jack. He was a crook. He made his money in Prohibition through rum running, and then he used it afterwards in the stock market. He was a crook. Roosevelt knew he was a crook, but he thought, well, he knows who the bad guys are. He knows how it's done. So he's the guy put in charge of the SEC. Well, for about 5 years, things got a little bit better. Some things were cleaned up, but then it just went right back to where it was before. And it's been dirty ever since. Now with computers, they're more sophisticated in how dirty they can be. Naked short selling is facilitated. You can do much more naked short selling by moving entitlements on computer than having some messengers take pieces of paper that are stocks, fake stocks, around between one broker and another. That really tamps down the crookedness. Now we have a greatly facilitated crookedness, but it's on the same order. And you would have thought, if they realized that watering the stock caused the stock market crash, they would have done something about it, except that they are the crooks, and that's how they make their money.
Yeah, I mean, I think that's the perfect note on which to leave this. So yeah, Lucy, thank you so much for your time. It's been an absolute pleasure. I would love to have you back at some point to talk more about your experience in the offshore world and your book once it comes out, because I'm sure that will be fascinating. So yeah, thank you very much.
And for people that are watching, if they want to follow this more, sign up to my Twitter, which is @LucyKomisar, because a lot of this information gets put on Twitter and on my website, which you can find through the Twitter.
Lovely. Links for everything will be in the description below. So anyone wants to find more of Lucy's work, I will put lots of stuff down there. So yeah, thanks very much.
Thank you.
Okay. Thanks so much for listening. If you enjoyed the show, please subscribe, follow me on Twitter, or sign up to our mailing list. Thanks a lot to our sponsor, Expressvpn, the #1 most trusted VPN. Get lightning fast connectivity with servers in 160 locations across 94 countries. Keep your browsing privacy safe with Expressvpn and get a 35% discount on 12 months of Expressvpn when you follow the link in the description below. Don't forget my book is now out and available to order on Amazon and on bookshop.org. That's Brexit, the Establishment Civil War. And most importantly, thanks for listening. We'll see you next time.